Hello, in this lecture we're going to calculate the break-even point. We got two calculations for a break-even point. We have the break-even point in units, and we're going to have the break-even point in terms of sales dollars, meaning that if we sell stuff, how many things do we need to sell in order for us to break even? And the other one being, if we sell stuff, then how much sales dollars then would we then pull in if we sold that number of units in order to break even? In order to do these types of calculations, we need to do the common breakout of our costs by behavior when we think about managerial accounting and decision making and planning, meaning we need to break out the variable portion and the fixed portion. And once we have the variable portion and the fixed portion, we can think about this concept of the contribution margin as well as the contribution margin ratio. So those are going to be some very important calculations that we use when we make decisions many times. Very applicable in a lot of different areas, but they are a number that is not on the standard financial statements. We're not going to find contribution margin or contribution margin ratio on standard financial statements because we're not breaking out by variable costs and fixed costs on the standard financial statements. Managerial accounting makes a lot of use of these types of calculations. So in order to plug the information into these formulas, we have the break-even point in units. That means that we're going to take the fixed cost divided by the contribution margin. So in order to do that, first we need to figure out what the contribution margin is. In the break-even point in sales dollars, we're going to take the fixed cost divided by the contribution margin ratio, and we can also do another calculation to figure that out as well. But in any case, first thing we need to do that calculation is find out what the contribution margin ratio is. So let's do that first step, and that's going to be the calculation down here where we're going to take the sales price per unit. I'm going to say tab, and that's going to be given to us in our data set, so we're saying it's 310 per unit. We're going to subtract from that the variable cost per unit, so that's given to us here, the cost per unit on a variable cost per unit. And I'm going to say that's the 186, so each unit costs us 186. We're going to go up to the Home tab, and we're going to go to the font and underline that, and that will give us the contribution margin per unit. So we'll subtract this out. So I'm going to say this equals the 310, the sales price per unit minus the variable cost per unit, 186, gives us the contribution margin per unit of 124. So that means every unit that we sell, basically, we're walking away with $124 after the variable costs, the costs that are usually directly related to the inventory. Now that means that we can then take that number and think about, okay, well, how many do we have to sell to cover the fixed cost? In this case, the fixed cost being the 421,600, and that's a very, very useful calculation to have. So if we wanted to figure out the contribution margin ratio, then we can take the contribution margin per unit divided by the sales price. So we could say, okay, well, that would equal the 124 divided by the sales price here, and that would give us 40%. Now that's been formatted, of course, so if we went to the Home tab and we added the percentage, it would change it would be 0.4, has been changed to 40%, moving the decimal 2 places over, and there we have that. So that's going to be the contribution margin ratio. I'm just going to say that equals that. All right, and then we can do the break-even in units calculation. So the break-even in units then would be fixed costs. So I'm going to say the fixed costs are going to equal the 421,600. I mean, but those are the things that do not change with the level of production. Things like the rent oftentimes is what I often think about when we think of the fixed costs. And we're going to divide that by the contribution margin per unit in this case. Contribution margin per unit, which already took into account the variable cost per unit. So that's what we're walking away with after variable cost. Sales price minus the variable cost. And that equaled the 124. I'm going to go ahead and go to the Home tab and go to font and underline that, and that will give us the break-even point in units. So that's going to equal the break-even point, this one here, in units. So we're going to say this is the 421,600 divided by the 124 contribution margin in units, and that gives us the idea that we need to sell 3,400 units in order to break even. That's how many we need to sell just to cover the fixed cost, just to basically kind of pay the rent in this scenario. Now note that if we wanted to then calculate a profit, if we wanted to estimate how much profit we're going to make, well, we can say, okay, well, what if we want to make 50,000 profit? Well, let's say fixed cost plus 50,000 divided by the contribution margin per unit, and that will be how much we believe we need to sell in order to cover the fixed cost and make a certain level of profit. So that's going to be that type of idea. Now, if we figure out the break-even point in sales, then we got to see how many dollars. This is how many units we're going to get, how many dollars are we going to get. Now, to me, I often, when I think about this, I just think, well, if that's how many units we need to sell, why don't we just multiply that by the sales price? And that's going to be one way that we can do it. But most of the times when you see it in the book, and it's very useful in different conditions, is that we're going to take the fixed cost divided by the contribution margin ratio. So I'll do it both ways, but this is what you're going to see most of the time. Fixed costs is going to equal the 421,600, same fixed cost here, and then we're going to divide that by the contribution margin ratio. Contribution margin ratio. And we calculated that up here. Remember, this is the contribution margin per unit. This is the contribution margin ratio, 40. And why is it 0? Because we need to make it a percent or add decimals. So if I went to the home tab, and if I added decimals, it's 0.4. If we make it a percent, it's 40%. And then we can, while we're up here, underline that. And that will give us the break-even here. That break-even point in sales dollars. So we're going to take the 421,600 divided by the contribution margin ratio, 40%, giving us the 1,054,000. So we need to sell this many units, which would give us this much revenue, which would then cover the cost, total cost being both the fixed and variable portion, using this calculation. Now we could have just used our other calculation, which would have just been the idea that if our break-even point in units is equal to this, if that is, whoop, what happened there? If that is equal to 3,400 units, and we just took that and said the sales price per unit, we said was, what did we say it was? $310. That's how much we're going to sell this stuff for. So 310, and we go to the home tab and underline that, then it would make sense that we should come out to the same number as this if we take the break-even point in units times how much we're going to sell those units for. That means we're going to walk away with revenue of 1,054,000, which would then cover both the variable costs and the fixed cost. And we could, of course, verify this if we put this into a contribution margin income statement. So let's just calculate this into an income statement and just see if it works. So we'll kind of do a proof here. So if we say that the unit sales, we're going to sell the break even in units is 34. So we're going to say 3400. We said, whoop, extra 0. And we said that the sales price was 310. So I'm going to say the sales price 310. I'm going to go and underline that. So I'm going to go to the home tab. I'm going to go to underline and multiply that out. That means that this is the sales in units times the number of units. That gives us our 1,054,000. Here's that number here. Then we're going to have the variable costs. So the variable costs are going to be the 3400. Did it again. 3400, and the variable cost per unit. We said that the variable cost per unit was the 186. So 186. That was given to us in our data, so we use that in our contribution margin calculation, contribution margin per unit calculation up here. So I'm going to go ahead and underline that, home tab, font, underline that. And that would give us our variable cost. So we say 3,004 times the 186, giving us our variable cost. I'm going to underline that, home tab, font, underline. That gives us our contribution margin. So our contribution margin is this number, the total sales, minus the variable cost portion. Notice we're not talking about the contribution margin per unit here. This is the contribution margin for this point, this data point, and that means that that gives us the contribution margin. Now the fixed costs, if we took a look at our data up here, were the 421,600, which of course is the contribution margin. 421,600. That's why it's the break-even point, because our contribution margin is going to be minus the same as the fixed cost, meaning we are breaking even. We have no income. We go to the home tab. I'm going to go to font, underline that. And also note that the contribution margin ratio here, just as we calculated it up here to be 40%, should be the same if we do the same calculation for the total contribution margin, meaning it would be the contribution margin divided by the total sales, enter. If we went back up here and went to the home tab and the percentage 40%, right? So we can see that, let's go ahead and make that blue. So we can see that it's going to be the same ratio. That's the point of the ratio, because the contribution margin will change at the same rate. So that's why we're using that. That's why we have to break out the variable costs and the fixed costs.